Now we are doing material. Basically, we are doing planning and operational variances. Planning and operational variances. When do we determine or when do we calculate or when we can calculate planning or operational variances? Planning or operational variances basically can be determined by an organization when organization is revising its budgets during the accounting period. Why an organization will revise its budget during the accounting period? Organization will revise its budget during the accounting period when actual circumstances are significantly different from the budgeted circumstances. During the accounting period, actual circumstances are significantly changing or significantly changed. When actual circumstances has changed significantly, what does it means? It means that we are doing what? We have to revise our budget. Planning and operational variances. So planning and operational variances are determined when we are revising our budget. Or when revision of budget is allowed, when actual circumstances are significantly different from the budgeted circumstances. First, you need to learn basic variance of material price variance. Basic is equal to budgeted or standard price per kg. It could be per meter, it could be per yard, anything. Minus actual price per kg into actual kgs purchased. Next one is basic variance of sales price variance. So remember these basic variances. Sales price variance is equal to budgeted price per unit or budgeted sales price per unit minus actual sales price per unit into actual units sold. So these are the basic two variances. You need to remember these variances. Now we are talking about planning and operational. Planning variance means what? The word planning is showing that difference between revised and original budget. Difference between two budgets basically. One is the original and the other one is revised. And what is meant by operational? Operational means we have performed an activity. So the operational variance is what? Difference between revised budget and actual results. After revision of budget, original budget has become a useless document. That's why we will follow the revised budget. First we have material price planning variance is equal to budgeted revised budgeted price per kg minus original budgeted price per kg into actual kgs purchased. This is planning variance. Then we have material price. Now I will make some necessary changes. Material price operational variance is equal to revised budgeted price per kg minus actual price per kg into actual kgs purchased. This is material price operational variance. Then we have labor rate planning variance. Now follow this concept. This concept says that revised budgeted price per kg. So here we will say revised budgeted rate per hour minus original budgeted price per kg, original budgeted rate per hour into actual kgs purchased into actual hours worked. In fact, not worked, into actual hours paid. If paid is not provided, in this case, paid and worked are same. So primarily paid. If paid are not provided, then paid and worked are same. Next one is labor rate operational variance. Concept is just like material price operational. Operational means after implementation of revised budget. Revised budgeted rate per hour minus actual rate per hour. Here we have actual price per kg. Into what? Into same actual hours paid or work. So this is called what? This is called labor rate operational variance. Next one is material usage planning variance is equal to total standard, sorry, total revised standard usage minus total original standard usage into original standard price per kg. Now you will not be provided either total revised standard usage and as well as not with total original standard usage. So total revised standard usage is equal to revised standard usage per unit into actual production into actual production units. This is total revised standard usage. Total original standard usage is equal to original standard usage per unit into actual production units. So that's why I told you memorize or revise variances formula on daily basis till exams. There are number of formulas in variances. Next one is material usage operational variance is equal to total revised standard usage minus total actual usage into original standard price per kg. Next one is material usage okay. No next one. Material usage operational variance is done. This is the material usage operational variance. Next one is labor efficiency planning variance. Just like the same concept of this material usage planning variance. Total revised standard hours minus total original standard hours into original standard rate per hour. Now total revised standard hours minus revised standard hours per unit into actual production units. Total original standard hours is equal to original standard hours per unit into actual production units. Next one is labor efficiency operational variance. Minus total actual hours into original standard price per hour. So these are the planning and operational variances. Anyone, any question? These are the planning and operational variances of material and labor. Labor efficiency planning variances total revised standard hours minus total original standard hours into original standard rate per hour. This is the formula which I wrote over here. Not to, and operational is total revised standard hours minus total actual hours into original standard rate per hour. Is there rate per hour? I mistakenly wrote the price per hour. Okay. So we are done with labor and material planning and operational variances. And as I told you that these are the simple variances. May be possible if he asks you to calculate sales price planning variance or sales price operational, although not provided in the question, but sorry, in the syllabus, I think. But if he asks sales price planning, same concept, revised, budgeted, selling price per unit minus original budgeted selling price per unit into actual sales units. And if we say sales price operational variance, we will make some changes over here. Revised budgeted selling price per unit minus actual into actual sales units. So these are the sales planning and operational variance. Next, very important is market size and market share variances. Market size and market operational size and market share variances. Basically, these are called planning and operational sales variances. Market size variance is called planning variance, planning sales variance or sales volume variance, or operational is called what? Market share variance. Now I'm going to write a data. For example, I say that we are selling digital diaries. Suppose budgeted sales units suppose we says that budgeted sales units of our company 50,000 units, and we are saying that our market share is 20%. Suppose actual market size is assuming like to 40,000 units. or 240,000 diaries. And we say that budgeted contribution per unit is equal to $20. So what you need to learn in your MCQs, maybe in BPP and Kaplan both, or either in one of the exam kits, MCQs or OTQs are given in this form. As I told you that actual sales, actual market size basically. Actual market size is 240,000 units or 240,000 diaries. Examiner will provide you data in this form. Here question is saying budgeted sales of our company is 50,000 units and our market share is 20%. Question did not tell you that what is the original budgeted market size. So first of all you will calculate original budgeted market size is equal to 50,000 into 100 divided by 20. Why into 100? Why divided by 20? It is 20% of the total market size. Total market size needs to be determined. So we followed the approach of gross up and we grossed up our budgeted sales of 50,000 from 20% to 100%. So original budgeted market size was 250,000 and actual market size is 240,000. Actual market size is also called what? It is also called revised budgeted market size because no other revised value is given, which is 240,000. So market size is called what? It is called planning sales volume variance. And out of this revised budget, we are determining revised budgeted sales of our company because we are saying that our expected market share is 20% of the total market. So we will say 240,000 into 0.2, 48,000. We should sell 48,000. Suppose we say actual sales of our company 49,200 diaries. Now we will calculate what? Sales or market size variances or variance is equal to revised budgeted sales of market minus original budgeted sales of market into budgeted contribution per unit. So we are saying that revised budgeted sales are 240,000 of the market minus original were 250,000 of the market into contribution is 20 and it is called what? It is called adverse. Why? Because originally market was saying that we will sell 250,000 but we are actually selling 240,000 the whole market. So the variance of the whole market is adverse. On the other hand, if we calculate market share variance, that what is our performance is equal to revised budgeted sales of our company minus actual sales of our company into budgeted contribution per unit. So revised budgeted sales of our company are 48,000. We should sell. Actually, we are selling 49,200 into contribution of 20. So this time minus does not mean adverse. This time minus means favorable. We are selling actually more units than the revised budgeted sales. So it is favorable. But here the total market is selling lower amount of units in comparison with the original budget. That's why it was adverse. So this is called what? This is called market size and market share variances. Anyone, any question?